to see a collateral inversion. I did a whole paper on this, probably more than one. What I mean by a collateral inversion here is people and nations, of course, dumping debt, dumping dollars, and moving into other asset classes, specifically gold and silver. And we haven't seen anything yet with regard to where they're going. I mean, look, for a very long time, stock market is 6 to 7 times overvalued in aggregate right now because of this rate suppression mechanism, currency devaluation, invest debt expansion. And what does the market do? It trades on higher multiples. I mean, this is basic finance here. But again, if this stuff made the headlines, people be running for the hills, and the struggle is just beginning. I'm not saying that people should, what I am saying is people should be looking for anything right now to circumvent the current debt-based system. And in my opinion, it's not going to change unless someone can convince me that I'm wrong.
The world watches gold reclaim the psychological $5,000 milestone, and silver battles extreme volatility after its historic surge. The precious metals market has reached a critical tipping point in February 2026. With silver demand hitting a 6th consecutive annual deficit and central banks continuing their aggressive de-dollarization through massive gold accumulation, the window to exit the debt trap of fiat currency is narrowing faster than most realize. In this episode, financial analyst Gregory Mannarino breaks down why he believes the entire global financial system is a time bomb fueled by unsustainable debt. He introduces his theory of a collateral inversion, where a massive migration of cash will flee overvalued stocks and devalued dollars for the safety of hard assets like silver and gold. Mannarino warns that we are entering a phase of maximum control, where permission freedom is the new norm. But is there still time to use the current system's cracks as your own escape hatch? And what happens when the Dow meets gold 1-to-1? And how do you come out on top? Stick around, because Greg's about to drop the exact play. Don't forget to like, subscribe, and enable notifications for additional in-depth content. Thanks for joining us again. Enjoy the video.
We're going to see a collateral inversion. I did a whole paper on this, probably more than one. What I mean by a collateral inversion here is people and nations, of course, dumping debt, dumping dollars, and moving into other asset classes, specifically gold and silver, and we haven't seen anything yet with regard to where they're going. Look, for a very long time, my thesis has been that we are going to eventually get a 1-to-1 Dow gold ratio.
Mannarino's signature thesis explained. 1. Collateral inversion is the mechanism. Collateral in financial system is typically debt instruments, treasuries, corporate bonds, MBS, etc. These are what backs derivatives, what central banks hold, what's used as safe assets. When collateral inverts, loses value trust, system must find new collateral is hard assets. 2. The whole paper reference shows this is studied theory, not off-cuff comment. Mannarino has developed this framework over years. It's his analytical lens for current crisis. 3. The inversion has 2 components: A, outflow from traditional collateral debt dollars losing value, and B, inflow into alternative collateral, gold, silver gaining value. It's not just one side, it's both simultaneously equals accelerating effect. 4. Haven't seen anything yet. Repeats for emphasis. Mannarino wants audience to understand current moves. Gold $5,000, silver historic volatility are just beginning. Main event still ahead. 5. For timing. Collateral inversions don't happen smoothly gradually. They're nonlinear with tipping points. System appears stable until suddenly isn't, like dam that holds until cracks, then catastrophic release. We're in the cracking phase. 6. The 1-1 Dow gold ratio is both prediction and measuring stick. When ratio hits 1-1, that signals collateral inversion is complete. Traditional financial assets down to parity with hard assets. Not there yet, 9-1 currently, so inversion's still underway. For action, if collateral inversion is inevitable and we're early to mid-process, the play is obvious. Exit traditional collateral, stocks, bonds, cash, and enter alternative collateral, physical metals, before masses do same. Days to prepare because window closing as more people wake up.
1-to-1, and by surmising or come up with our best estimate as where the market is here. First of all, look, man, the stock markets of the world in aggregate are nothing but derivatives of debt market action. This is pretty much obvious, and I think most people that understand finance, even in the most basic sense, realize that's exactly what's happening. There is not a single asset class today that has a price discovery mechanism because of that thing. Now, this mechanism here has pushed global stock markets into, I think they don't belong here. The U.S. stock market is 6 to 7 times overvalued in aggregate right now because of this rate suppression mechanism, currency devaluation, vast debt expansion. And what does the market do? It trades on higher multiples. I mean, this is basic finance here. But again, if this stuff made the headlines, people would be running for the hills and, of course, getting out. But
This is critical valuation context for why collateral inversion will crash stocks. 1. Derivatives of debt market action means stocks don't trade on fundamentals, earnings, growth, competitive position. They trade on liquidity from debt expansion. When debt expands, Fed prints, Treasury borrows, liquidity floods into stocks, pushing prices up regardless of business performance. 2. No price discovery mechanism is damning. Price discovery is when supply-demand freely set prices based on real value. Instead, we have administered prices via Fed intervention, rate suppression, QE, backstops, etc. This is artificial. 3. The 6-7 times overvalued is specific. Mannarino is saying fair value for U.S. stock market in aggregate is 15 to 20% of current level. Dow at 45,000 fair value would be 6,500 to 7,500. S&P at 6,000 fair value 850 to 1,000. This is catastrophic gap. 4. The 3 mechanisms causing overvaluation. A. Rate suppression equals artificially low borrowing costs inflate present value of future earnings. DCF models make stocks look cheap versus bonds. Currency devaluation, nominal prices rise as currency unit loses value, inflation effect. C. Debt expansion, it creates liquidity that chases assets. More money chasing same stocks equal prices up. 5. Trades on higher multiples equals PE ratios, price to book, price to sales, all extended versus historical norms. This isn't sustainable, it's bubble territory. 6. If this made headlines, people running for hills reveals the information gap. Mainstream media doesn't report truth. Stocks massively overvalued, system on brink, so most people unaware and unprepared. 7. For silver, when stocks crash 70 to 85%, revert to fair value, that cash doesn't vanish, it goes somewhere. Collateral inversion says it goes to hard assets. Silver with supply deficit becomes target for trillions in capital flight equals explosive repricing. 8. The days to prepare urgency make sense here. Stocks at nosebleed valuations with zero price discovery can crash suddenly when liquidity reverses. No warning, no orderly decline, just gap down. Get out now.
Look, the bottom line is this: we have to say what's actually happening here. If the world doesn't want our debt, the world doesn't want our dollars, the world doesn't want our products here. American people can't even afford our products here. Henceforth, this retail sales numbers that we just got out this morning here. If people can't buy, our factories are going to die. Our factories are dying, as I said they would prior to the presidential selection here in the United States. All the lies and the propaganda that is being spilled out of its mouth. Trump is a thing. It's a creature. It's not even a human. None of them are. They don't possess a single human quality. It's all about raping what's left of our nation, unfortunately, and the 1 and 2% are winning while the rest of us are losing. Now, with that, this is going to bleed off to the rest of the entire world. The United States is the hub, absolutely, but the mechanism behind it is the same. Now, gauging from where, if we have a market in reality that's 6 to 7 times overvalued here, we have to say, okay.
The death spiral mechanics exposed. 1. 3-part rejection equals total crisis. A. World doesn't want our debt, treasuries being dumped. B. World doesn't want our dollars, dollarization, bilateral trade in local currencies. C. World doesn't want our products, trade deficits, loss of manufacturing. This is comprehensive rejection. 2. American people can't even afford our products is internal crisis, not just external, foreigners rejecting, but domestic, locals priced out. Recent retail sales collapse confirms this. When your own citizens can't buy your products, economic death spiral begins. The cascade. People can't buy, factories can't produce, job cuts, less income, people can't buy more, repeat. This is deflationary collapse pressure. 4. Government's only response. One function in this mechanism, inflate. Can't allow deflationary collapse, debt defaults, bank failures, political upheaval. So must inflate, print money, suppress rates, expand debt. 5. Suppress rates is the mechanism. If rates rose to natural levels, say 7 to 10% to reflect real inflation plus credit risk, debt becomes unserviceable. Government itself pays $1 trillion a year interest at 4 to 5% rates. At 10% rates, that becomes $2+ trillion equals impossible. So rates must be suppressed. 6. Expand or die mechanism is key. System requires exponential debt growth to function. Any slowdown equals collapse. Like Ponzi scheme that needs ever-growing inflows to pay previous promises. This is terminal design, not fixable. 7. For silver, this expand or die means unlimited printing capacity will be deployed when crisis intensifies. That printing destroys currency, drives inflation, makes hard assets, silver, more valuable in purchasing power terms. Price shock comes when printing accelerates. 8. The days to prepare context. Retail sales already collapsing, job cuts starting, yet government will respond with massive inflation. Only tool they have. Front-run that response by holding silver now before it becomes obvious to everyone.
Where's the bottom? The bottom is probably somewhere around 8,000 for the Dow, maybe lower than that. Okay. And then the 1-to-1 gold, we're going to hit probably a 2-to-1 gold and probably a 10-to-1 silver. So with regard to the price action, look, man, it's just a collateral inversion. That's all it is. Cash moves through the markets in predictable patterns. There's no guessing here. We don't have to speculate. Maybe have to think, okay, we can say this is overvalued and this is undervalued by this amount. That, yes, I will give you is a kind of a speculation here. But what we can say is a vast amount of cash is simply going to move, as I've been trying to explain to people now for over 10 years. It's a pretty simple dynamic, and that's exactly how it's going to play out. The bottom line is the system is being taken apart only to issue one of maximum control. They already have the people surrendering their freedoms and liberties willingly so moving forward. And the struggle is just beginning. I'm not saying that people should, what I am saying is people should be looking for anything right now to circumvent the current debt-based system. And in my opinion, it's not going to change unless someone can convince me that I'm wrong. I will see the collateral inversion situation that we're going to see unfold here is going to push cash into, of course, what I feel like is the most undervalued asset class on earth, and that would be precious metal, silver, number one, gold, number two, platinum, palladium absolutely should be in your portfolio. I think exposure to copper as well, commodities overall as well should be, at least from a financial standpoint here, in your portfolio or in your repertoire of an escape hatch, getting out of the debt-based system. But the nature of the debt-based system is not going to change. This is how those fraction of a people maintain control by forcing people, free people apparently, to participate by force in their system. This is permissioned freedom. This isn't real freedom.
The Fed Treasury machine is now trapped in its own trap. Nations worldwide are dumping U.S. debt and dollars like hot potatoes, forcing the complex to buy it all up and suppress rates even harder. Bad economic news? Stocks still climb because markets bet on endless intervention and fake liquidity. The real cost lands squarely on everyday Americans through crushing inflation and lost purchasing power. Gregory Mannarino lays it bare. No more hiding. The system's rigged against the people, but you can still fight back personally by understanding cash flows and protecting yourself. How much longer until the burden becomes unbearable? And what move are you making right now to shield your future? Watch till the end for Greg's straight talk on turning the tables.
Let me say this real quick. We don't have to guess about anything. There's no guesswork. We clearly see, and I'm certain this goes for everyone that follows your work, as well as mine, where things are going, the dynamics in play. It's too simple. They don't even try to hide anything anymore. The entire world financial system is a time bomb, and they're fueling it with more debt. Here you got nations again looking to disconnect themselves from the dollar a unit of debt, of course, U.S. debt itself here, U.S. treasuries. This is no secret. Who's buying it all really is where we have to sit back and look at. We already know who that is. It's the Fed Treasury complex. They're not going to stop. We are going to see further rate suppression on a massive scale, which means whatever nation is dumping U.S. debt, getting rid of U.S. dollars. This has to be absorbed, has to go somewhere. With regard to treasuries, what nations are holding, the Fed's going to buy it all. They put themselves in this. The Fed Treasury complex has put themselves now in a checkmate position for against the American people, of course, as they have become the lenders and buyers of last resort. Now, with the dollar here, the world turning its back on the dollar, these dollars are going to be absorbed, unfortunately, by the American people. These dollars that are not being utilized in whatever form they may exist. Of course, it's 99% digital is going to become rushing right back here to the United States, and there's not a single firewall put up to stop that from happening. Can we stop it now? Absolutely, we could. We need to return purchasing power to the currency, the polar opposite of what our president and Treasury Secretary are saying, along with the central bank, who is more than happy to continue to inflate the entire system. So it's pretty obvious here. But there are steps that we can all take care of from a personal standpoint here to turn the tables on those here that are destroying us from within period the end. So that's really, I mean, the gist of it is basically this. It's no secret, and anyone that thinks it is really is disconnected to understand how cash moves through the system and why. If we can lock into that, and which we are, it makes it too simple to see where the ends are going. Now, with the economic news, it's not going to stop. We just got an extremely disappointing retail sales number here in the United States, and stocks are higher. The worse the economic news is, the higher the market's going to go, because what all the market cares about is how much intervention the Fed Treasury complex is going to inject into the system here, how much fake liquidity, how much they're going to inflate from here, devalue the currency. And of course, who's going to bear the burden of all that is the American people until they push back. And unfortunately, for the general population, they're not pushing back.
The inverted logic of manipulated markets. One, disappointing retail sales, stocks higher, is proof markets aren't free. In normal economics, bad economic data is lower stock prices. Companies will earn less. Instead, stocks rise on bad news. Why? Worse the news, higher markets go reveals the game. Bad economic data signals more Fed intervention coming, rate cuts, QE, liquidity injections, and markets front-run that intervention by rallying. It's Pavlovian. 3. What market cares about is intervention, is admission, not earnings, not growth, not fundamentals. Only thing that matters is how much fake money Fed will inject. This is dystopian finance. 4. Fake liquidity equals money created from nothing, keystroke at Fed, with no real production backing it. This is theft via debasement, dilutes everyone's existing dollars to benefit asset holders. 5. How much they're going to inflate, devalue currency, is the mechanism. Every intervention requires more debasement. Eventually, hyperinflation becomes reality. 6. American people bear the burden until they push back is crucial. Mannarino sees the injustice. Elites get bailouts, cheap credit, masses get inflation, stagnation, but acknowledges people aren't resisting. Unfortunately, general population not pushing back, from later clip. This means exploitation continues. 7. For silver, if bad news equals more intervention, equals more inflation, equals currency debasement, and this pattern is systemic, not temporary, then silver as inflation hedge becomes essential holding, not optional, essential. 8. The days to prepare make sense. If markets are rallying on bad economic news now, retail sales collapse, wait until really bad news hits. Job losses, production shutdown, trade war escalation. Intervention will be massive, inflation will spike, silver will explode. Get positioned before that's obvious to everyone.
But thanks to shows like yours, and I would like to say mine, we are raising awareness to the situation, and at least we can take care of our own. I see the world realizes where we're at. It's the American people who don't have any idea, because they're being conditioned, they're being programmed via the mainstream media and, of course, a political angle to shift blame anywhere else but on themselves. If, for example, here we weren't in an environment where yields are being artificially, who would want to own U.S. debt, or the U.S. dollar for that matter, also a union of debt, which is being squeezed from every end here, losing purchasing power, including the debt. I mean, people want to hold debt at these rates. You got to be out of your mind. It's a guaranteed losing, quote unquote, investment. No one wants this stuff, and that's the danger. which I've been trying to scream about for a very long time now, why the Fed Treasury complex is in here buying it all right now, managing the yield curve, keeping rates suppressed to foster or continue to foster the wealth transfer effect. If in fact nations are dumping U.S. debt, and we know they are, they're all distancing themselves from U.S. debt right now. Who's buying it? You can't have a seller without a buyer. So I mean, it just comes down to one word: duh. We all know who's buying it here, and it's not going to stop. This mechanism is going to continue to get worse. The brunt of the impact of this is going to be borne again on the backs of the American people, on their futures, on their children, of course.
The endgame mechanics revealed Fed as buyer of last resort. 1. Guaranteed losing investment is mathematical certainty, yet someone must buy treasuries to fund government. Since market won't, negative real yields, Fed must equals ultimate monetization. 2. Fed Treasury complex buying it all is admission of failure. When central bank must buy its own government's debt because no one else will. That's classic precursor to hyperinflation. Weimar, Zimbabwe, Venezuela all followed same path. 3. Managing yield curve is technical term for price fixing. Instead of letting market set rates based on credit risk inflation expectations, Fed forces rates lower by buying unlimited amounts. This is manipulation. 4. Wealth transfer effect is key. Low rates benefit borrowers, government, corporations, wealthy with access to credit, at expense of savers, retirees, middle class, anyone holding cash bonds. This is deliberate policy transferring wealth upward. 5. Nations dumping is observable. Treasury tick data shows sales, yet Treasury prices haven't collapsed, which would happen if sellers buyers. Why? Because Fed buying it all equals duh. This is smoking gun of monetization. 6. Can't have seller without buyer is logic. If China dumps $100 treasuries, someone bought those $105. Since Japan also selling, Europe not buying, Middle East diversifying, only buyer left is Fed, directly or via proxies like Belgium. 7. Not going to stop is prediction. This is new normal until system breaks. Fed will buy treasuries indefinitely to suppress rates and fund government. This means dollar debasement accelerates. 8. For silver. Fed monetization equals currency debasement equals silver repricing upward in purchasing power terms. Not speculation, mathematics. If Fed prints $2 to $5 trillion annually, as may be required, silver's finite supply means proportional price gains. Price shock equals catching up to currency debasement.